Welcome to the Daily Brief, where I'll go over the action in the market for Friday, December 2nd, and then see how things look for Monday, December 5th. And we had a down day, and the employment situation report came in stronger than expected. So we saw a kind of a solid down open. We were down about 1%. But after that, we spent the rest of the day coming back. And so if you just take Friday's session by itself, which I'll show you here in just a moment, it's really more positive than it may appear. We're still at that point where the market is taking good news as bad news because the employment situation report came out greater or higher or stronger than expected. There's this fear that if the employment situation holds up, the Fed's going to keep raising interest rates, or they're not going to slow down as quickly as the market would like. So the market was kind of hoping that this report would be in line with what they thought, or even weaker than expected. We probably would have seen prices go higher at that point. So on the other hand, it's good for the economy. It just shows that at least in the employment area, the economy is still hanging in there, even though some other areas are still showing some weakness. So let's go back and talk about what happened. Right at the open, we did have a gap lower. This about an hour before the market opened is when the employment report came out. We gapped down to S2 at 40.26, and then we rebounded up to S1 at 40.53. As the day went on, prices spent most of the day just kind of drifting higher. We actually got above S1, which then as we came back down, that provided support. And then we came all the way back to the unchanged level. We went just a little bit positive there briefly. And then from there, we ended up closing down just a little bit. So a lot of the damage that we saw at the open was repaired during the session. We were down 0.12%, and volume, which is kind of strange because this is the biggest employment or the biggest economic report of the month, and to see volume really drop off on a Friday, it's kind of strange. The strong volume day that we saw was on Wednesday when everything really took off after Chair Powell's speech. The technicals are still holding up. That's kind of what I'm going with right now. We're still above support. We have a lot of resistance above where we're at. But for the most part, our oscillators are still positive. Our setups are hanging in there. The sector rotation, not as much. And if you want more of a look at these other setups and rotation, please look at Friday's video where I go through those. I don't cover those in this video. The inflation and interest rate scenario seems to be a little bit more market friendly now, but we're going to be watching each economic report as they're coming out to see, is good news going to be bad news? And then at some point, the market may go too far with that, and then we'll shift over to good news is good news, bad news is bad news. But right now, we're in this idea that anything strong might put the scenario of lowering interest rates or slowing down into jeopardy. All right, so let's go back and talk about what happened where we gapped lower right down to S2, which is kind of interesting. We were right down at the pivot from Thursday's session, but this was when the low was established, was right at the open. We came back up to S1, came back down a little bit. We were able to get above S1, came down, and then the S1 area acted as support for a lot of the day. We were a little above, a little below. But then late in the day, and this is usually encouraging because this is the smart money coming in and doing things, they pushed prices up to the unchanged level, went slightly positive, but then going into the close, we backed off of that, but then we saw some buying right at the very end. So it does show some improvement, even though it was a down day. What are some comments? The S&P, it showed resilience after being down 1% at the open. Prices did fall below the 200-day simple moving average, but we rebounded above that and closed above that. The dollar did decline. It was down, and interest rates continue to fall. And I do have some interest rate charts to show you. The VIX is still extreme negative. And then on a short-term basis, we're still looking overbought. with the Stochc RSI, the Williams percent R, our moving average studies, the stochastics, all of those are pretty much pegged in extreme positive territory. Doesn't mean we have to stop, but some of this wearing off or slowing down that we've seen on Thursday, and that is just because it's showing short-term exhaustion, basically. But then the recovery that we saw on Friday, at least at this point, should be taken more as positive. On an intermediate term basis, we still have the rate of change looking back 20 periods, the CCI, both the 14 and the 20, and the BPI. And I do have the BPI chart to show you. Our yield curves are still inverted. That still hasn't changed, and that's suggesting economic weakness at some point in the future. But at least we're hanging in there right now. It's all about employment for the most part. Sentiment is still positive, even with the slightly down day. We're not extreme positive. We're not back to neutral, so we're leaning more towards the positive side. And the non-farm payrolls that came out, it was at 263,000, which was a lot more than expected. They really only thought there'd be 200,000 coming out, but it still declined from the previous month. Last month, we had 284,000. The private payrolls came in at 221,000. Again, they also expected 200,000. The last time it was at 248,000. So we're seeing greater than expected, but weaker than last time. The average hourly earnings, they were up 0.6%. And this is kind of an area that the market fixates on because this can produce some inflationary problems. They expected it at half of that, at 0.3%. The last time we got this, it was at 0.5. So that actually ticked up a little bit. The unemployment rate was unchanged at 3.7%, and the average work week, it fell 34.4 hours from 34.5. Our trend is still positive. It's still going up, still riding that wave from Wednesday's action. So we're still above 20. I'm keeping our bias at positive right now. We did have 2 down days, but they were minuscule. And so the backdrop is still looking more positive. Now, we could lose that in the upcoming week, but we just have to go with what we see right now. And I'm keeping the momentum at positive also. Just in case you're seeing this for the first time, this is a chart that I found on Twitter where we're tending to go with the same basic pattern from 2006 through 2008. That's the white line is what we're doing right now. It hasn't been updated, but this green line is what actually happened. And again, this is just kind of a warning sign because we might see some weakness going into the end of the year if we still stick with this basic pattern that we saw back during leading up to and into the financial crisis. Also, the VIX. The VIX is getting very low right now. It's below 20. This is suggesting that we might see some real increase in volatility, which typically happens when prices go down. Our rate of change, looking back 20 periods, that is still extreme positive. And here's the BPI, which it's been holding up all along, even with the holiday week on lower volume. And earlier in the week when we were going down, the BPI still held up. Now, the BPI, they take all the stocks in the S&P 500 and they say which ones are generating a point and figure buy or sell signal. So when this is going up, that means that all of those point and figure charts inside the S&P 500 are improving. They're showing that we're going up and up and up. However, we're getting kind of to an extreme positive reading here. And other times when we did have this marked some kind of a top in the market. So we want to be aware of that. The VIX continues to decline. Even with a down day in the S&P, we're still dropping below 20, which is the static number. So we're getting down to pretty low levels here on a closing basis. And the bar chart is also continuing to go down. I tend to use more the moving averages when we're above or below to try to find more of a range, because just to say we've dropped below 20, that used to work better, but now we need to be more fluid with things and be more relative to how is the VIX acting in relation to how it's been acting. Here is just showing where the VIX, looking back 9 periods, it just shows that the VIX has really been falling. And so the RSI is getting back down to extreme negative because we've been going up as the VIX has been going down. Here's our trend where we're still above 20 and we're above the moving average. The green line's on top, even though it declined. So we're still looking more positive with our trend. And the equity put call ratio, it's still pretty high, but it's really coming down. Even with a down day, even with a lower open like we saw, we're seeing a lot of the equity put call ratio begin to fall. And we're on a 5-period basis, we're also seeing a decline. And here's our daily chart where we're right about at this longer term, either resistance or support, depending on where we're at, but we closed just about at this level. And we're below this trend line right here. We came right up to that trend line and came back. We're going to need to see good volume and a lot of buying to take us above this trend line and then close above that trend line. And then this red line is the 200-day moving average, where we did fall down below that, but then came back up and closed above that. So that's seen as positive for right now. And then at the bottom, we see where there's a drop off in volumes in Friday's session. Here's our moving average tree, again, coming down to the 200-day exponential moving average, and then fell through the simple moving average, but then we're able to close back above that. And this will help a lot of things. On a daily basis, it's always more positive when we close above this moving average. But now that the week is ended, our weekly charts will show some improvement. And I have another chart to show you here in just a moment. The new highs, new lows didn't really get much higher in Friday's session, but overall, we're seeing a trend upward with our 5-period, and we're turning up with the 10-period. Now, this is a warning sign here. This is our Swinland trading oscillator, and sometimes this is a leading indicator for us. Even when we had the massive up day, even when we've been hanging in there, we're still seeing the STO based on price and volume decline. They're still positive because they're above zero, but to see this declining is a little bit concerning. Then we're still pretty much in no man's land as far as our short-term fib levels, but support has been holding up, at least so far. And then longer term, also coming back down, we broke a little bit through this support level, the dark blue line here, but we were able to close back above that. So that is positive as well. This is the weekly chart where this whole bar represents 1 week, and we were able to close above this 40-period moving average, which equates to a 200-day moving average on the daily charts. So this helps to make our longer term charts show improvement. And I wanted to show just some bond prices, how we really hit a bottom here and have been bouncing ever since. Can that continue? Because as bonds continue to go up, that will push interest rates down, and that's what's been happening, and that's been giving support to stocks. So here's our total bond ETF, and then here's our world bond index, where it was able to break back above what had been resistance and is showing some improvement. Then here's looking at the interest rate for the 10-year, where we were way up over 4%, and we've been coming down, and that could give some support to the stock market. And then looking at all the different maturities here, where shorter term we turned up just a little bit with the 2-year, but for the most part, a lot of the longer term maturities have been declining. So what's our outlook for Monday? The technicals are positive and they continue to hold up. We need to see if the battle continues in this coming week, and will the bulls win? Will the bears win? But right now, things are still hanging in there, but we are short-term overbought and a little bit overbought in the intermediate term. We're still asking this question, has the pivot happened? The market is pretty much treating this, yes, that it has, at least to this point. It was a little bit concerning to have the employment report come out stronger than expected, but we have some other reports coming out, and we'll just have to take them as they come out to see if the economy is showing a slowdown or if it's really picking up. On Monday, we have the IHS Market Services Purchasing Managers Index. The final report will come out. That's not a real biggie. We have factory orders, and then the big one will be the ISM Non-Manufacturing Index. We had the manufacturing index this past week. Well, this coming Monday will be the non-manufacturing index. And then all the geopolitical events and the markets, anyway, with all the other things going on, are still fixated on this inflation interest rate scenario. I have the looming railroad strike. My understanding is it passed the House, it passed the Senate, and it's been signed by the president. So it's looking like that railroad strike has been averted. So that's pretty good news for the economy. Our scenarios not going with the down scenarios unless in the really short term we continue to be exhausted or overbought to the point where we see a decline. We're going with more of the positive scenario right now, but we are overbought in the short term and slightly in the intermediate term. Our scenarios didn't really improve all that much. In fact, some of them declined, but they're still holding up. The sector rotation needs a lot more love to get that going more positive again, but it has been improving lately. So our technicals are still hanging in there. We're still above some moving averages, pivots, and fib retracements. So until we break through that, things are still leaning over towards the positive side. And sideways, not going with that because the ADX is above 20 and we are positive. So our conclusion, the S&P is positive and continues to hold up. Short term, it is overbought and continues to be overbought. Intermediate term, it's positive, but also slightly overbought. Long term, as long as we stay above these moving averages, that helps the long-term trend to improve, but we're still negative until the 50-period moving average crosses above the 200. So thank you. Have a wonderful weekend, and I'll just kind of take it. This might be the only video that I post over the weekend. And if that's the case, I will talk to you in the next video.